Hello, Nick Stewart here, and in this video we're going to look at buy-to-let properties and investing in the United Kingdom, especially focused for overseas investors, and why the UK market is still one of the better markets in the world to invest into. So let's get into the video and have a look. So let's start this video with the obvious caveats. This is not financial advice. This is just to help you understand the UK property market a bit more in educational purposes. For transparency, I own a boutique real estate called Great Stewart that sells investment properties and lifestyle properties in Spain, the UK, Portugal, and Thailand, to name but a few. Right, let's get on to the UK property market. Number one factor that you should know about the UK property market, by 2030, there's going to be over 70 million population here, and there's already a huge demand and undersupply of property as it stands, but the population is going to get more, there's going to be more demand, and really property prices are only going to go up. As this video is recorded, February 2023, we might even go into a minor recession, and property prices might dip a bit. But if you take the medium to long-term view, which you should do with all investments, not just real estate, but with crypto, with stocks and shares, with buying and selling businesses, whatever you're investing in, you should always be taking a 5-year point of view, not investing for the now, if you like. Anything less than 5 years, in my point of view, is speculation. As for the property markets, right? So number one is and always will be London. Only problem with London is you need about 600,000 sterling minimum to enter the market for good location. Yields aren't that great, but you're probably going to get the most capital growth in London. Secondly, by a million miles, is Manchester, which is more or less a mini London, but without the, you can get into Manchester probably from 250,000 sterling into a good location and a unit in that area. So it has a different entry level. Manchester has a lot going for it, like Amazon. I've personally invested in Manchester in an off-plan property project, which I think completes in 2025. Again, I took a medium to long-term view, which is over 5 years. And then you have other areas. So I think I could pick 3 areas for you: Leeds, Liverpool, and Birmingham. Birmingham is the second city of the UK and obviously has all the fundamentals to be a really great investment hub. Secondly is Liverpool, where Liverpool is actually very, even though parts of Liverpool is very poor and very socialist, there are a lot of affluent people, probably more affluent people in and around Liverpool than there are actually in and around Manchester. But by that area, I'm really talking about Southport, Formby, Birkdale, and the likes, which are really fantastic, very rich areas. And I think a survey a while ago from Coutts Bank actually found that there were more millionaires in Coutts Liverpool branch than there were in Coutts Manchester branch. That data may have changed since. That was a survey quite a few years back, but it gives you an idea of. And then you have the great thing about Liverpool. You have the redevelopment of the docks area, the Everton Stadium if they ever get their act together. Lots of really interesting things. So those are the marketplaces to look at. Great opportunities in all of those areas. And then what you need to do is look at it as for a foreign investor. So in a foreign investor, at the moment, if you invest via a UK limited company, it's about to change to 25%, but currently it's 19% corporation tax. Now, if you were to buy that in your own name, for example, you'd be paying up to 46% tax. Not advised, but generally, if you buy one property in one company, you mitigate the tax incredibly brilliantly, right? So you don't get hit with if you're keeping it under 500,000, again, you'll have low stamp duty. You're keeping your your buying tax is low. And the great thing about the UK is filing taxes and accountancy services are not that expensive. There's one company called SiteGround, great company based in Hong Kong. And I believe, I don't know if their fees are up to date, but the last time I spoke to them, they charged £250 a year to do the accounts and £500 to set up the company. So you have very minimal costs. And the great thing through the tax structures is, at the end of the day, all the money that you put in to acquire the unit, you can actually take that out tax-free, because in essence, you're loading the money to the company before you have to start even thinking about paying taxes. You will have to pay some taxes on the rental income that you're receiving. However, if you're, again, this is why a lot of investors will use finance, which is somewhat skewed a little bit now, because obviously the rate of interest is going up, but you can offset your interest payments off against 100% of those against your rental income, which you can't do as a private individual. So again, doing it through an SPV or a UK private limited company, it is much more tax beneficial. But those are the factors that would make you want to invest in the UK property market. And all I can do is highly recommend it. The question is, where else do you invest, right? So if you go into Spain or Portugal, that's just a lifestyle investment. I guess you could go. So you need to be looking. If you don't want to be in the UK, maybe go to Paris, you go to New York, you go to Tokyo, but the prices generally are much higher. So so what you want, basically, if you're an investor, you want low overheads, good yields. And we didn't know yields. So yields in Manchester are somewhere between 6 to 7%, depending on what price you buy at. London's probably 4-5%. And some of these up and coming areas like Liverpool, Leeds, and Birmingham, you might get a bit higher, up to 8%. So good yields, and cost of finance is still less than that, even with the interest rates going up the way they've been going up. But obviously, right now, as we talk in February 2023, cost of finance is an issue in regard to investment strategy. But that you make that decision if you're a low leverage business or not. So if you're low leverage, you're going to pay some tax on the income you receive. But if you're happy to use leverage, then you can reduce that. As I said, it depends what type of investor you are, because I've covered this in other videos. At the end of the day, you're either an investor that's looking to make money, in which case you probably use leverage because you can make more, you can gear and make more money. You also have more financial exposure. But if you're looking to keep your money, then you probably don't. You're buying assets to keep without any leverage at all. So UK, highly recommended. Number 1, London. Number 2, Manchester. Number 3, I would go Liverpool / Birmingham, and then you have cities and other places after that. So I hope you found the content interesting. If you did, hit the like button. Please subscribe to our video channel, and do hit the notification bell if you want to receive more informational videos like this one.
Thanks for watching the video, and please feel free to connect with me on my personal website, nickstewart.co. Really looking forward to hearing from you. Bye for now.